If you blinked, you missed it. And if you're only watching silver when it's going straight up, you're already late to the real story. Because what just happened wasn't normal volatility. It was a message, a reminder, a warning shot fired across the bow of anybody who thought this market was going to behave politely. Here's the twist. I'm not panicking. I'm not even mad. In fact, I'm going to say something that sounds backwards. I sleep better after a slam than I do after a vertical melt-up. Not because I like seeing people lose money. I don't. But because the crazier the spike, the more likely it is that you're looking at paper momentum, options gamma, and leveraged money chasing a headline. Stuff that can evaporate in minutes. And when that evaporates, the market doesn't die. It resets. It breathes. And then it gives you a clue about what's real. So in this video, I'm going to break down the who, the why, the where, and the how behind the latest silver slam. We'll talk about what typically triggers these air pockets, why the reason you're hearing is usually a convenient story, and what the hard numbers are quietly saying underneath all the noise. And don't skip the second half, because the part nobody is talking about is what happens next, inside the delivery calendar, inside the inventory math, and inside the leverage machine that decides whether this was a temporary punch or the start of a deeper shakeout. Also, check the description when you're done. I left bonus links there, including a premium WhatsApp channel link and a channel membership join link, so you can choose how you want to stay plugged in without chasing rumors. All right, let's set the stage. When silver is calm, most people forget one uncomfortable truth. Price discovery in modern metals doesn't happen the way your brain wants it to happen. A lot of folks imagine a clean little auction. Buyers show up with cash, sellers show up with metal, and the price lands somewhere in the middle. But in reality, the day-to-day price is often steered by a derivatives complex that's orders of magnitude larger than the physical market moving between hands. That doesn't automatically mean a cartoonish one villain controls everything. I'm going to challenge that in a minute. But it does mean this. If you're new, you need to understand that paper positioning can move silver faster than physical demand can respond, especially in short windows where liquidity is thin, emotions are hot, and stop losses are stacked like dominoes. So yes, silver can be shoved down hard. Not because the world suddenly stopped needing it, but because the market structure allows it. Based on recent market updates, the most active U.S. silver futures contract printed an enormous range recently, swinging from triple digits down into the mid-80s in days. To put the whiplash in perspective, the front silver contract recently showed a single-day range stretching from the mid-70s to well over 100, and a 52-week range that runs from the low 30s to north of 120. That's not a little choppy. That's a market that's been living on adrenaline, and it explains why slams feel like trapdoors. Gold's front contract has also been swinging in huge bands, with recent ranges running from the high 4,000s into the mid-5,000s. And the gold-silver ratio? People act like it should snap back to some magic average, but the past couple decades have seen it stretch from the low 30s to well above 100. So when you see it in the high 40s, don't treat that as destiny. Treat it as a temperature reading. It tells you the market is nervous, not that silver is wrong. And nervous markets love to fake you out before the real move. And if you're sitting there thinking, okay, but why now? Why this slam? That's where the story gets interesting. Because every slam comes with a headline, a neat little explanation that makes it feel logical. This time, the narrative floating around is some version of, a hawkish shift is coming, a new central bank leader could tighten policy, the dollar strengthens, and metals have to drop. Maybe you've heard that. Maybe you've seen the talking heads repeat it like it's gravity. And yes, expectations around rates and the dollar can hit precious metals. That's real. But here's what's also real. Headlines are often just the wrapper. They're not the engine. When a market gets slammed, the reason is frequently whatever fits the calendar that day. A rumor, a quote, a data point, a political whisper, something simple enough to put on a chyron. Meanwhile, the actual mechanics are sitting backstage pulling levers you never see. So I want to separate two things, the story you're being sold and the machine that can make that story matter. Let's start with what didn't change. Did the world stop installing solar panels overnight? No. Did the electronics industry suddenly decide it doesn't need silver in contacts, solder, and components? No. Did EV supply chains magically rewrite their bill of materials in a week? No. Technologies can thrift silver over time, sure. Manufacturers always try. But meaningful substitution is a slow grind, not a weekend decision. And recently published numbers still show industrial silver demand remaining massive, with solar alone pulling a staggering amount of metal into production lines. For example, the solar sector's silver usage was reported around 200 million ounces in a recent annual survey. So if the real-world demand engine didn't suddenly collapse, then why the air pocket? Because paper can do what factories can't, move instantly. Now, I promised I'd challenge the "there is no free market" claim. Here's my take. It's not that silver is some perfectly fair, angelic market. It's not. Like most major markets, it has big players, algorithmic strategies, and a heavy reliance on futures and options. That opens the door for squeezes, dumps, and games that feel ugly. But saying nothing is real is a trap too. Because if nothing were real, silver would never recover after a slam. It would just drift. Instead, what you see, over and over, is that these violent moves can't erase the fundamentals. They can delay them. They can distort the path. They can punish people who use leverage. But they can't delete physics. And silver is physics. It's a critical material in a world that's electrifying everything, where power efficiency matters, and where reliability in components is non-negotiable. So here's the more accurate model. The paper market can bully the price short-term, but the physical market can corner the paper market long-term. That's the chessboard. Now, let's talk about the excuse. In the last few sessions, precious metals also got hit in other venues outside the US, with sharp downside moves being pinned on a strengthening dollar, profit-taking, and policy uncertainty. Again, plausible. But plausibility isn't proof, because the slam had the fingerprints of something mechanical, a move fast enough to trip stops, force margin calls, and trigger automatic selling into illiquid moments. This is where the click of a mouse idea comes from. Not because there's literally one person clicking one button, but because the infrastructure is built for speed and scale. When the market is crowded on one side, it doesn't take a conspiracy, it takes a cascade. Think of it like a packed theater with one narrow exit. If smoke appears, you don't need a villain to cause a stampede. The structure itself creates the stampede. Now, what crowded this market? One word: leverage. Silver runs attract leveraged traders because the moves are bigger than gold's. That's the thrill. That's the danger. And when the run gets hot, options dealers hedge, momentum funds pile in, and the whole thing can go vertical. Then, when price turns, leverage becomes a trap. The exchange can raise margin. Brokers can tighten. Volatility spikes. People who were investors discover they were actually tourists holding a ticket with an expiration date. From recent market chatter, margin changes were even cited as a factor amplifying the downturn in some trading venues. Now here's the cliffhanger. If leverage was the fuel, what was the spark? Because the spark matters. It tells you whether this is a routine shakeout or a deliberate reset ahead of something bigger. So let's follow the spark trail. A lot of eyes are on the central bank narrative. Who might be in charge? How aggressive they might be? Whether rate expectations shift. That's not crazy. Markets trade expectations. But the more important question is this. Why did the market react with such violence if it was just a change in expectations? Answer: because expectations were the excuse that allowed positioning to unwind. And when positioning unwinds in silver, it's never gentle. Now let me take you to something most people ignore: the way derivatives can create supply. Here's what I mean. In a physical market, you can't sell what you don't have. If you want to sell silver, you need bars, coins, or some claim that is actually deliverable. In a derivatives market, you can sell exposure. Lots of it, immediately. This isn't automatically evil. Futures have legitimate uses: hedging, liquidity, price signals. But the side effect is that supply of paper silver can expand much faster than supply of real silver. And when a market wants to cool off a move, expanding paper supply is one of the fastest ways to do it. That's not my opinion. That's just how derivatives function. And here's where it gets spicy. Years ago, a former top regulator openly described how introducing futures can bring discipline to a rising asset by allowing short exposure to flow in. The language was polite. The effect was blunt. Translation: if an asset is running too hot, giving institutions a clean way to short it can cap the move. Now, I'm not saying that's the only factor here, but if you want to understand why silver can rocket and then get flattened, you can't ignore the role of the paper short side. Because silver is one of those markets where concentrated short interest has been debated for years, and every time price gets wild, that debate gets loud again. So, what do we do with that? We zoom out to the numbers that can't be argued with: volumes, inventories, delivery behavior, and real-world demand. Let's talk volumes first. The futures complex saw eye-popping activity recently, with trading value and volume spiking hard during the run. When you see that, it tells you something important. This wasn't only stackers buying coins. This was a full-blown financial event. And financial events can reverse fast. But financial events also leave footprints. Here's the footprint I'm watching. Did this slam actually break the underlying demand, or did it just flush the leverage? Because if it flushed leverage while demand remains intact, that's not bearish long term. That's the market clearing its throat before the next move. That's why I said I sleep better. Now, let's hit the gold-silver ratio, because people love using that as a compass. Recently, the gold-silver ratio was sitting in the high 40s, around 48 and change, after silver's big moves. When that ratio climbs, it often means silver is underperforming gold. When it drops, silver is outperforming. But here's the trap. People treat the ratio like a law of nature. It's not. The ratio reflects a tug-of-war between two different markets with different drivers. Gold is heavily monetary and macro. Silver is monetary and industrial, which means it can get yanked around by both fear and growth narratives. So the ratio can swing wildly depending on which story dominates. What matters more is what the ratio is telling you right now. The market is pricing in uncertainty, and uncertainty tends to favor gold first. That doesn't mean silver is broken. It means silver is being asked to prove itself again after a crowded run. Now let's go to the part that separates tourists from people who actually understand this space. Delivery. Most people trade silver like it's a chart, but silver is a metal with a delivery calendar. Contracts roll, notices go out, bars move, or they don't. And when delivery months get tense, weird things happen. What we've seen in recent years is persistent talk about tightness, deficits, and shifting inventories. According to a major industry overview, total silver demand in the most recently reported full year was around 1.16 billion ounces, and the market has been dealing with repeated deficits, largely because industrial demand has been stubbornly strong. Now, I'm not going to pretend every ounce of deficit means there's no silver left. That's another trap. Deficits can be met by drawing down above-ground stocks, recycling, and shifting inventories. But repeated deficits do one thing reliably. They reduce the cushion. And when the cushion is smaller, price shocks become more likely. That's the part people miss. Now here's the next cliffhanger. If the physical cushion has been shrinking, why did the price just get crushed? Because that seems backwards, right? Unless the slam was never about the physical reality, unless it was about behavior, specifically discouraging the herd. Because when silver is screaming higher, new buyers show up. Retail tries to pile in. Everyone starts talking about the new era. Then the slam happens and the herd gets spooked. It's not a conspiracy to say markets do this. It's a psychological pattern that repeats in every asset class. So what should you do with that pattern? First, don't use leverage unless you can survive the gut punch. Silver is not a gentle teacher. Second, if you're building a position, think in tranches, not all-in hero moves. Third, separate paper price action from physical strategy. If you're holding physical, the point isn't to win a weekly candle. The point is to own an asset that doesn't rely on a counterparty. And yes, that's still relevant. If you're successful, share your success story in the comments so others can stay motivated. Now, let's talk about the who in a way that doesn't turn into a cartoon. It's tempting to point at one company, one bank, one name, and say, that's the villain. Real life is messier. Modern markets are networks, banks, funds, dealers, market makers, and algorithms that respond to flows. But there are still power centers. And one of the biggest power centers is the rulebook itself. Who is allowed to do what, with what leverage, and with what reporting? More participants can mean more liquidity. It can also mean more ways for paper to dominate the tape. So when someone asks, who did this? My answer is, the structure did this, and the biggest players within the structure know how to exploit it. Now, the why is where we need fresh thinking. The competitor narrative you saw floating around is basically, they must suppress silver because it would blow up the system. Here's my more grounded take. Silver matters because it sits at the intersection of money psychology and industrial necessity. If silver price surges too fast, it doesn't instantly end civilization, but it does cause stress. It stresses manufacturers who have contracts and margins. It stresses funds with short exposure. It stresses traders who assumed a certain volatility regime. And it stresses policy narratives because a surging precious metals complex can signal that confidence is cracking. So yes, there is an incentive across different groups for silver to not become a daily headline about currency distrust or supply shock. But that incentive doesn't require a secret basement. It requires incentive alignment. And when incentives align, the market tends to do what's most convenient for the powerful. Shake out the weak hands, keep the system stable, and let the asset rise later in a way that feels orderly. That's the game. Now, let's bring in fresh data that wasn't in the competitor script, because this matters for your next move. First, solar. The solar industry's silver consumption has been rising for years, but what many people don't realize is how sensitive it is to installation cycles and policy support. Even with ongoing efforts to reduce silver per cell, total solar deployment has been so large that overall silver use in PV has stayed enormous. In one recent report, PV demand for silver in a single year was reported near 198 million ounces. Second, electronics and electrification. Industrial demand wasn't just strong, it was described as hitting record levels recently, especially in electronics and electrical applications. Third, the deficit narrative. Some recent commentary projected another structural deficit year, even as certain categories of demand softened, which tells you the market remains tight in the areas that matter for modern tech. And fourth, the price reality. Just a few days ago, gold was reported trading above $5,000 per ounce amid uncertainty, with silver hovering near record territory before the flush. That matters because it tells you this isn't some tiny niche corner. Big money is watching. Now, the skeptical angle. Here's what I don't fully buy. The idea that paper can keep this down forever. Paper can stretch the timeline, it can create brutal drawdowns, it can ruin over-leveraged traders, but it can't manufacture physical silver at scale. And the demand story is not a meme, it's industrial. If the world keeps building out grids, data centers, EV infrastructure, and solar, silver stays relevant. Which brings us back to the slam. I think what you just witnessed was a leverage purge, potentially amplified by policy rumors and risk-off positioning, not a death sentence for the thesis. But I'm also not going to sugarcoat it. If silver can drop this hard in days, it can do it again. So the real question isn't, will silver go up? The real question is, can you stay in the game long enough to be right? That's where strategy matters more than prediction. Now, let's talk about the how, because I want you to be able to recognize the pattern next time before it happens. Step 1, price runs. Step 2, mainstream attention increases. Step 3, derivative activity explodes. Options, futures, leveraged ETFs, all of it. Step 4, the market finds a catalyst to justify a reversal. Rate talk, dollar talk, margin talk. Step 5. Liquidity pockets appear, stops trigger, forced selling hits. Step 6. The story changes from silver is unstoppable to silver is dangerous. And right here, at step 6, is where the opportunity usually hides. Not because you buy blindly, but because you observe whether the slam actually changed the physical reality. So what do we watch? We watch whether premiums stay elevated in physical channels. We watch whether inventories draw down or stabilize. We watch whether delivery months show stress, higher standing for delivery, unusual movements, or sudden shifts in open interest. We watch whether industrial demand slows materially, not just in headlines, but in actual reported usage. We watch whether the gold-silver ratio stabilizes or continues to widen. We watch whether the dollar move is a real trend shift or a short-term squeeze. Now, I want to zoom in on something new that most people missed: product innovation on the exchange. The exchange is planning to introduce a 100-ounce silver futures product, pending review, which is a big deal because it lowers the barrier for certain participants and can change liquidity dynamics. That might sound boring. It's not. Because when you change contract size, you change who can play. And when more players can play, the market can become deeper, but also more reactive. More reactive means more whipsaws, which means more slams. So if you're wondering, why does it feel like silver is getting wilder? That's part of it. Now, let's walk through the delivery calendar logic without making your eyes glaze over. Non-delivery months tend to be quieter, but that doesn't mean nothing happens. They can be used to reposition. They can be used to roll exposure. They can be used to set up for the big months where real pressure shows. The biggest delivery months become focal points because that's where paper meets the option to demand metal. And even if most contracts are cash settled or rolled, the delivery mechanism still anchors expectations. That's why the market cares about it, even when people pretend it doesn't. Now, here's the payoff loop. March. I'm not making a prediction that March will be the mother of all deliveries. I'm not going to do that hype. What I will say is this. When you've just had a violent run and an equally violent slam, the next major delivery window becomes a magnet for speculation. People start asking, will longs stand? Will shorts offer metal? Will inventory shift? And when those questions get loud enough, volatility returns. So if you want to understand the next phase, watch positioning heading into the next major delivery period. Now, I'm going to address a common misconception. People hear delivery and imagine trucks and forklifts. Sometimes there are real movements, yes, But often, delivery can also mean the transfer of ownership of warehouse receipts, while the metal stays in the system. That's not inherently fake, it's how warehousing works. But it does mean that you can't look at one headline number and assume it reflects metal leaving the ecosystem. You have to watch the net changes, the category shifts, and the patterns over time. That's why some analysts focus on trade data, imports, and industrial draw, because those are harder to handwave away. And when you look globally, silver flow into key manufacturing regions has been robust. We have publicly available data points suggesting certain importers have been consistently pulling in huge amounts of silver, even when price was lower, because their demand isn't speculative, it's operational. Now, here's the cliffhanger that ties everything together. If industrial demand is real, and deficits have been persistent, and exchange products are expanding, and volatility is rising, then why would anyone ever sell silver? Because timing is brutal. Because the path matters. Because most people don't lose by being wrong. They lose by getting shaken out. So if you're asking me what I think this slam means, here's the clean version. It means the market reminded you that paper sets the tone short term. It means leverage got punished. It means narratives can flip overnight. And it means you should build a plan that doesn't require perfect timing to survive. If you're stacking physical, the plan is usually simple. Accumulate over time, don't chase parabolic moves, and don't let a slam convince you the world changed in a weekend. If you're trading paper, the plan is more complex. Size appropriately, respect volatility, and never assume a breakout can't reverse. Now I want to ask you two questions, and I want real answers in the comments. First, when silver slammed, did you panic, did you add, or did you do nothing? Second, what's your line in the sand that tells you a slam is just a shakeout versus a thesis-breaking event? And seriously, if you're successful, share your success story in the comments so others can stay motivated. Now let's zoom out again and talk about what the market is really reacting to. Confidence. When gold is breaking new ground and silver is whipping around like a live wire, it's usually not just about jewelry demand. It's about trust. Trust in currency purchasing power. Trust in policy stability. Trust in growth forecasts. Trust in the idea that risk can be priced neatly. And lately, the macro backdrop has been a cocktail of uncertainty. We've seen elevated safe haven interest, and gold was recently reported pushing into record territory above 5,100 before easing. That tells you the market is already in a defensive posture. In that kind of environment, silver becomes a battleground. Half defensive asset, half industrial input, fully volatile. Now, I'm going to put a pin in something that might surprise you. The competitor script you gave me paints this like an on-off switch. Either the riggers are gone, or they aren't. I think that's the wrong frame. The real frame is, how tight is the system today compared to yesterday? Because markets can be managed and still break. A dam can control a river until the river rises too high. So the question becomes, are we seeing signs of the river rising? And based on recently published numbers, the answer is yes in at least a few places. Industrial demand has stayed historically high. Solar continues to be a silver-hungry machine, and futures trading activity has reached extreme levels during the run. Those are all signs of pressure. But pressure doesn't tell you timing. Pressure tells you direction. Timing is the knife. That's why I keep coming back to strategy. Now, let me give you a practical lens for the next couple of weeks. If silver continues to bleed while gold holds up, watch the ratio. If the ratio keeps widening, it suggests silver is being treated as risk-on exposure that's being sold harder. If the ratio stabilizes in the high 40s and then starts compressing again, it can be an early tell that the silver market is finding its footing. The ratio recently near 48.6 gives you a reference point. Next, watch volatility. The exchange highlights implied volatility measures for silver, and while you don't need to be an options nerd, you should know that when implied volatility is elevated, the market is pricing bigger swings. Bigger swings mean higher risk,